Good morning, everyone. This is Dana from NexGen, and welcome to December. I hope everyone has had a fantastic week thus far. If you remember, back in November, we spotlighted a multi-generational couple on their wealth journey. And one of the things that they were looking into was ways to use their home's equity. So they had done the refinancing of their mortgage. They had done the home equity loan, and they'd also done the home equity line of credit. So they were actually looking into reverse mortgages. So we actually explored in the following videos what what reverse mortgages mean. And we also talked about what home equity meant. Then after that, we talked about some of the questions that people had about reverse mortgages. And there are probably some other questions that you may have. So definitely make sure that you include them in the comment section. So today, I would like to talk about, there's three reverse mortgages programs that are available. And the one that is most used is the home equity conversion mortgage. So for the next few weeks, we're going to be talking about home equity conversion mortgage, or HECM. So as I said before, the home equity conversion mortgage is one of three types of reverse mortgages. So this is the only one that is insured by the U.S. federal government. And so that's the Housing and Urban Development. So I am going to include a link down in the description if you need additional information. And the mortgage is only available through the FHA approved lenders. So they have lenders that participate in the program. So the reverse mortgage under the FHA, it allows the borrower to withdraw a portion of the home's equity. And we talked about in the previous video what home equity meant. And they could use a portion of it for home maintenance, for repairs, or general living expenses. So there's no restriction on how they can use this type of reverse mortgage. And the borrower can it stays in their home indefinitely as long as they take care of the property taxes and the homeowners insurance, and they're made sure those are kept current. And we'll talk about why that is important in a few minutes. There's also some other things that need to be done, but as a minimum, this is what I wanted to bring your attention to. Now, how this is different, the HECM is different from the single purpose reverse mortgage, is that the single purpose reverse mortgage is for what it says, a single purpose. So with the HECM, there is no restriction, whereas the single purchase reverse mortgage, there is a restriction. And that's usually offered by state, local, and nonprofit agencies. And it's usually the least expensive option. So if HECM is not something that doesn't meet your needs, then we do have the single purpose reverse mortgage. And usually I would see that with someone that needed to pay, let's say, the property taxes. The third type of reverse mortgage is called a proprietary reverse mortgage. Now, with the HECM, there is a limit. For example, the lending limit for 2023 is $1,083,300. With the proprietary reverse mortgage, that's backed by private lenders. So the benefit for this type of reverse mortgage is for those who want more money and those people that have homes that appraise at higher values. So there are three types of reverse mortgage. And so the one we're going to be focusing on is the one that is used most often and the one that is insured by the federal government. Before we get started, I think it's important to take a look at what is comprised of a mortgage, because this is going to be important when we talk about reverse mortgage. Let's talk about how people would normally get mortgages. In this example, we're going to use a $500,000 30-year mortgage. So I will tell you that if the home is sold, let's say for $500,000, the seller is going to be receiving less than $500,000, and the borrower or the buyer is going to pay more than $500,000 because of the fees and the commission of the real estate agents and different things that need to be done. So for this example, we're going to use the straight $500,000 amount for a 30-year mortgage. So what a mortgage is usually comprised of is the principal and interest. And in some cases, and we talked about it in the previous video, they could include property taxes and homeowners insurance. And they usually show it as what they call escrow. And then the last thing I wanted to go over is homeowners association dues or condo dues. Now, those are usually separate from the mortgage, but the reason why I included it in this video is because it's very important to know that this plays a part in the reverse mortgage. So in this example, I'd like to show you how it breaks out. So for a 30-year mortgage for $500,000, the person at an 8% rate, so we're going to use 8% in this case, they're going to be paying $3,668.82 a month. So that's for $500,000, 30 years at an APR of 8%. So that's what they're looking to be paying. Now, that represents the principal and the interest. And if you looked at my other videos, you will see that if they pay that amount for the 30 years, then the interest they'll be paying more interest than principal until the 14th year. And then I'll also be talking about how much, and I think that the interest is going to be well over $820,000. And that's in addition to the $500,000. So that's for the 30 years. So during the mortgage, or during the time the person owns the house, they're also going to be paying property taxes. So in this scenario, the property taxes are $7,565 a year. They also are going to be paying homeowners insurance. And in this scenario, we're going to use homeowners insurance of $1,500. Now, whether you pay the taxes or the homeowners insurance independent of the mortgage, the lender may require that they pay it as part of what we call escrow. The property taxes, non-negotiable. Homeowners insurance, non-negotiable. So the only thing that I can see that people can do as far as the property taxes is if there's a discrepancy on how your taxes were assessed, then you can appeal it. The same is true for the homeowners insurance. You want to make sure that you review the insurance to make sure that it meets your needs. Now, the lender is going to have their minimum requirements. So Just make sure we're clear on that. So we've got the principal and interest, which is $3,668.82 a month. That's principal and interest. Then we have the interest and the property taxes. Because those are assessed by the year, what the lender will do is they will add them together and divide them by 12. And because it usually changes every year, what they do is they may pad a little bit to make sure that they're not in what we call a deficit. So they want to make sure they have enough money in what we call the escrow to take care of the property taxes and the homeowner's insurance. So you will see that the payment for the mortgage, if you have the principal, interest, and the escrow, will be, in this case, $4,502.15 a month. So that is what your mortgage could look like. Homeowners Association or HOA dues are usually separate. And so in this scenario, it's $100 a month. Some of them take the dues by the quarter, some take them annually. So this is what makes up a $500,000 30-year mortgage. Now, let's say that you purchased the house, but you did not take out a mortgage. Then what you would be responsible for would be the property taxes, the homeowner's insurance, and I highly recommend you have it. We'll talk about that later. And if applicable, homeowners association dues or HOA dues. The reason why I spent so much time talking to you about what usually makes up a mortgage and showing you an example of the payments and talking about how much interest you would actually be paying with the scenario that I gave, with the interest that you would actually be paying more in interest than you would in the principal balance or the loan balance, is because I wanted to show you that the reverse mortgage works on your home's equity. And the only payment that would adjust the home equity would be the principal. So the more principal you make, or more of a payment you make in the principal, then the more equity you'll have. You'll be paying interest. You're going to be paying property taxes, homeowners insurance, and homeowners association dues. But the only thing that is going to increase out of all these payments, the only thing that's going to increase your home equity is the principal. There are a few HECM requirements that I'll be going over in the next few weeks, but one of them is having the financial resources to continue to make timely payments on ongoing property charges, such as property taxes, homeowners insurance, and homeowners association fees. Now, there's a few others that I'll go into, but the part that they don't have to pay back while they're in the program are the principal and the interest. So that is one of the requirements. So out of the payments that a person would normally make, and usually you won't have if you own the home outright or have that, which is one of the requirements. Now, it's either own the home outright or have a considerable amount of equity, because they don't want to see any liens. That these are some of the things that you would have to pay anyway. But when you're taking out the loan, it's the principal and interest that you would not have to pay. So, in the next few weeks, we're going to be talking about some of the frequently asked questions that we had about reverse mortgage and specifically the home equity conversion mortgage, which is the one that is used most often, and it's the one that's federally backed. So, I look forward to your questions in the comment section. I am going to include links to the HECM program from the FHA and the HUD website. So look forward to sharing additional information with you. Don't forget to like, share, and subscribe, and I will see you next week.